Hey everybody, welcome to today's game plan. It is time to get into the action. I am pumped because I have so much to discuss with you guys today. There's some major market moving action. We're seeing the S&P futures decline sharply. Bitcoin's even upticking a little bit. I want to get into the action right away. So the first things first, yesterday, markets had a good rally, right? We saw a pretty solid move to the upside. Ultimately, we closed almost at the highs of the day. It looked like things were returning to the so-called normal. Problem was, last night, right, about 8 p.m. Eastern time, maybe 9 p.m. Eastern time, the futures began to decline. And essentially what happened here was China reported that imports declined by a whopping 12.4%. Think about that. Imports into their country down 12.4%. Exports, which is them exporting to the rest of the world, declined, let me get this right, 14.5%. Think about that. 14.5% year over year decline in exports. Now, if you just look at this data, what does it mean? Well, imports tells you that their economy is in dire straits, right? Their consumers are not consuming. Their consumers are holding their wallets and not spending. So that's a huge negative. Now, we already knew that China was in trouble, right? We already knew that China basically was stimulating because their economy was stalling so quickly. The government's told us that. But the kicker here is that if you look at the export number is the worst number since basically COVID crash. We're talking back in early 2020, March, April, May of 2020. Think about what was going on in the world at this point. We were basically back then thinking there was going to be total, dysfunction. Everything was ground to a halt. There was lockdowns. And again, it made sense that people weren't spending because they were freaking out that the world was going to end. Obviously, it didn't. But the point is, this export number tells us that not only the globe is slowing, but it gives us insight into what the U.S. economy is likely doing as well. So that's a kicker, and we saw the future starting to decline. So right now, I want to show you this. Let's go over to this chart right here. This is the S&P 500, and ultimately what we're seeing here, this is the daily S&P. We're basically seeing big red candles starting to form, guys. And this is the opposite. And the reason why I'm drawing your attention to this is because if you go back here, big red, green, green, big green, big green, big green, small red, small red, small red, small red, big green here, look at the switch that we've seen, right? So we've seen this switch where we're now getting big red candles, which is telling you that bigger volume on the sell side is coming in. This is institutional volume. So you had the gap up here and big reversal. Then we got small green, small red, big red, small green, big red. Decent green right here, not as big as this, but you know what? Today the S&P futures are negating that entire move yesterday coming into the open. So my point of drawing your attention to this is there's been a fundamental shift in price action. All right, not only were we making low, higher, low, higher, low, higher, high, higher, high, higher, high, we're now making lower high, lower high, lower high, lower low, lower low, along with the candle function, meaning the big reds are now starting to form while the greens are small, which is the inverse of what we saw over here. All right, so I want to go over here. We're going to take a look over here, guys. Let's keep this thing moving here. So I want to show you now talking a little bit about cycle analysis for the Nasdaq, all right? So what we have here is the Nasdaq. This has been an amazing rally, absolutely amazing rally. The reason why bulls are so confident in this rally is because it is the longest bear market. If it's a bear market, it would be the longest bear market rally in history, right? So epic move to the upside here, longest period. But what I have a concern about is this, is that you basically have a cataclysmic event brewing where you have the fastest rate hike cycle in history, and now you have the longest potential bear market rally or maybe bull market beginning as well. And so they both can't be right. You either have interest rates that are going to eventually cause this to roll over, or you have a new bull market that's going to come up to double top, maybe pull back, and then break to the upside. So which one is it? Well, what I love to do is I love to look at the charts. And the charts, they're just very simple. It is what it is on the chart. And as a chart reader, that's what we have to do. So as long as we're below this pivot high, that pivot high is the dominant pivot point on the chart. It is the highest point. As long as we are below it, you have to respect that high. Now, if we flip back to past cycles, all right, so let's go back to the past cycles. Let's go back to, which one is this one? 2007. So in this situation, here was your dominant high. We pulled back, we had a big dump, and then look at this. This kind of chop action before the big dump out into the lows of 2009, essentially the end of the bear market, culminated with this flush out here. By the way, we haven't seen that type of flush in this market yet, just a heads up on that. But notice this price action. Notice the down, bounce, pullback, bounce, and then go to the current cycle, down, bounce, down, and then kind of bounce up. It's very similar. It's very similar as people are lulled into this false sense of confidence that this is a new bull market. All right, so again, if we flip back to that one, we can see down here and then kind of this same sort of U-shape or hook shape in the market that we had that we currently have. Now, if we go back even further, take a look at this, guys. This is the 2000 tech bubble. Here we have a cataclysmic rise, and I think this is very useful because if you look back at the current cycle, right, cataclysmic rise, right? Cataclysmic rise, very similar to 2000 with the dot-com bubble collapsing. If we flip back to 2000, sharp decline, and then look at the same U-shape, the same U-shape. Now again, the bulls will tell you, and they could be right, listen, anything is possible, right? Everything I do is probability based. There's never 100% of anything. So there's always a chance that the bulls could be right. This is a new bull market. But again, for me, that's your dominant high. And again, yes, were there people saying this was a new bull market here? Here, absolutely there were. And what we know is that in the tech bubble, it continued to collapse into '01 and even into '02. So again, my point here is just to show the similarities from past big cycles in the Nasdaq to make sure that people at least are informed. You don't have to listen to what I say. You do what you want. You got to make your own decisions. That's what this is all about. But I want you to understand when you're hearing the mainstream media and all these economists talking about bullishness and this is a new bull market and everything's going to be fine and it's going to be a perfect landing, you have to understand past cycles and how they worked out. Now you might say, well, why is this bear market rally, if it is a bear market rally, why is this one the longest one in history? Couple reasons. Number one, I think the labor market has stayed strong because again, you have people that companies, employers that it was so hard to find employees that they don't want to fire them right now. They're hearing that it's going to be a soft landing or no landing at all. They're like, man, it took me 2 years or a year to find this qualified person for this job. I don't want to let them go. But that's just one point. The other side is that you had so much liquidity pumped into the market during COVID and the years following COVID that liquidity does take a long time to dry up. And that can create longer bull or bear market rallies, in my opinion, like this. Throw in the AI craze, and again, you have the makings of why potentially this could still be a bear market, even in spite of it would be the longest bear market history rally. All right, so that's a couple things. The other thing I want to just point out here, guys, is that there's a credit crunch or credit crisis brewing here. And one of the things I want to point to is Italy, right? In fact, let's bring it back to the center console here. So in Italy, right, you basically just got an announcement from the government that they're going to do a 40% windfall tax on all bank profits. Let's rephrase, let's think about this. So again, folks, 40% tax on all profits across the board for banks in Italy. Now, where's this coming from? Well, I'll tell you. This is what is going to become more and more normal, and I'm going to tell you why. When you have deficits, when you have debt to GDP ratios of where they are for countries, and you're talking about the US at like 130, 140, Japan 250% debt to GDP. I don't remember what Italy is, but it's over 100% for sure. And ultimately, when you have that, these countries are going to have to raise tax revenue to pay the debt down. All right, either that or they're going into default. And default, again, imagine the U.S. going into default, let alone the credit crisis that would be unfolded if Italy and some of these other countries went into a credit crisis from default. So there's going to be more of this, and this is going to panic investors more and more. It's the beginning. I'm warning you, this is the beginning of it. But over the next 5 to 10 years, you're going to see more of this because these countries have to raise tax revenue. In addition, what's going on in Europe is you have a massive slowdown. So what kind of tax revenue are they really getting when there's such a big slowdown? So their tax revenue is declining, their deficits are spiking, which by the way is the same thing in the US, and they're going to have to figure out. And you You might say it's not going to happen here in the US, but don't be surprised. If it comes down to either the US defaults or they levy X amount of tax on corporations, they're going to levy that tax on corporations. The corporate tax rate will go up to compensate. So don't fool yourself. Granted, this is an early warning for the US over the next 5-10 years, but it will happen, mark my words. All right. Couple other things we have to go over here, all right? So I want to talk a little bit more about a few different charts out there. So in fact, let's see here. I think I want to slip over to this chart here, and what we're going to do on this chart is now bring up a couple different things. So the number one thing is based on what the market is telling us this morning with a big gap down, we have the 10-year yield actually starting to drop, and the dollar is actually gaining strength. Okay, so you might say, well, why is the 10-year yield dropping? I mean, why do we see the 10-year yield this morning down pretty sizably? And the answer is it's a flight to safety. So when people get panicked, they say, get me out of stocks, I'm going to go into bonds. The more demand for bonds, the lower the interest rate comes because you don't have to offer as high an interest rate for people to come and rush in. They already want to get in for safety, so interest rates come down. So for those of you that wonder why bonds go up and down or yields go up or down, that's a key component. The other is obviously credit worthiness and all that other stuff, downgrades, upgrades, all that kind of stuff, inflation. But when a credit event occurs, like we're on the verge of here, you have to understand that, again, people are going to rush into U.S. stuff, and therefore the yields will fall a little bit. Also, it tells us that the economy could become weaker, and therefore the Fed may be forced to ease as well. All right, the other thing I want to mention here is let's just jump over to the DXY real quick. The dollar is having a pop. We're still at resistance on the chart right here, but again, the dollar is up. Why? Because the US dollar is still the reserve currency of the world. And when there's fear out there, when you have Italy putting a 40% tax on banks, when you have what's going on in China going on with a massive slowdown that's going to get pushed all around the globe, and honestly, folks, do we really think that, I mean, you know, this is where it comes down to. This US American exceptionalism, like, are we that naive that we're not going to be affected by what's going on in China, second largest economy, almost overtaking the US? It's going to have an impact. You have to be ready for it. Okay, so jumping over to this chart now, I want to take a look at what gold is doing because this is interesting. Gold is actually down today. Now, that probably is due to the fact that we see the US dollar rallying, but ultimately these fear factors, meaning money is rushing into the dollar versus gold, at least for now, they're usually short-lived. I.e., when you had COVID, gold actually collapsed very quickly, but then rallied back up. So I'm still in the camp that gold is still putting in a bullish flag pattern here on the chart. We can even adjust the chart ever so slightly to even bring it down right to there. There's your trend line. Bullish pattern here. You still have this lower level of support that if I zoom out, that again is that scene of the crime, breakout, return to the scene of the crime right here. Now you're making a nice bullish flag. I do anticipate us rallying to the all-time highs and breaking out by year end. Now, if we go to a couple other things, now silver is an interesting one, right? Because silver is kind of an industrial metal. So the key on silver is this. Take a look at this level here. So here's your level on silver. This is my target zone for a swing trade buy on silver. I'm not going to tell you guys that I'm going to be going long term on silver because I don't know yet. But I will say that this culmination, see how these two trend lines, and let me show you guys again where these trend lines are coming from. Okay, so you have this area here connected to this low. It gives us that print. You also have this little pivot low. Those are converging. That means that's going to be a good swing trade, most likely on silver. Okay, so again, I'm looking at this. It's right around $22, give or take, maybe $22.25. That's your level on silver. All right, I have a couple stocks here that I want to go over pre-market. Datadog is getting pummeled. Take a look at this drop here in the pre-market, guys. They reported earnings this morning. Big drop on earnings here. Huge down move. Basically closed from what I'm seeing around 105 to 106 yesterday, trading at $83.90. Okay, so that's a kicker here. Where is your level to buy this? Well, we're going to take a look right now. We're going to take a look at the chart. So this line, this dotted line is where it's currently trading. I'm going to be looking at, all right, so there's a little gap fill right here that would be interesting to me. It's at $79.50. So $79.50 would be intriguing as a day trade. This is day trades. Remember, day trades are in and out quickly. So if you do decide to take it, you take it at your own risk, obviously, but that would be a level there. And then the big level down here would be these pivot highs. You have pivot point here and here, and that's at 71.80. I don't think it gets there today. If it gets there today, this market's in a whole lot of heap of trouble. Okay, so UPS also reported. I'm going to quickly go over that. Then we're going to go over some macro charts because I got some big stuff to show you guys real quick. UPS, which is a good gauge of the U.S. economy, dipping on earnings, so that stock is coming down. I have no level for a trade here on UPS unless we get to $66. This pivot low right here, currently trading at 76, not unheard of to see UPS dump out 10 bucks during the intraday. It has done it in the past, so it could do it. That would be my level right there. All right, so I want to go back to here, guys. I want to show you guys some interesting macro charts. So this is a really, really interesting chart that I came across. And basically, this is weekly appearances in news stories for the term soft landing in light blue and hard landing in news stories. All right, so that's the dark blue is hard landing or recession. Light blue is obviously soft landing, no landing, going to be perfect. We're going to sing Kumbaya for the rest of our lives. What you can clearly see is that if you look here, look at the height of stories that are claiming that there's going to be a soft landing in the economy. I use this as a contrarian indicator, just like search results for the term recession. You can use it as a signal as well. When everyone's banking on recession, it likely isn't going to happen. We saw that earlier this year. All right, early this year, everyone was looking it up. If you look at the search results now for recession, it's like minuscule compared to where it was. All right, so here we have, again, huge divergence from articles that are talking about hard landing or recession, which probably would be me, I'm in that camp, versus soft landing. So just notice the divergence, how ridiculous it's got here, how oversized that has gotten. All right, next chart I want to bring up here, look at this one. This is U.S. employment total versus U.S. employment part-time, all right? So full-time versus part-time. The blue is full-time, the orange is part-time. Look at this, the orange has spiked. So part-time work is spiking, full-time work is actually going negative. And again, for economic purposes, that is not a good sign, folks. When people are looking for jobs, the general person isn't going to be like, oh yeah, I'd love to find a part-time job. Yeah, occasionally someone says that, you know, if they're a mom and they're staying at home or a dad that stays at home, they might want to look for part-time work. But in general, most people want full-time so they can actually buy a house, so they can actually feed themselves, so they can actually buy a car or lease a car, which now is $750 the average lease or car payment. I mean, it's ridiculous. My point is that's not a good indicator right there. All right, next one, guys, we got to go to this one. This is now the market starting to go in the direction, and I'm just going to say it, guys. I've been calling this for a million years, well, really for the last year, saying that inflation, long-term inflation is going to be stuck above 2%. Well, guess what? All of a sudden, this chart shows you basically the expectations for inflation over the next 5 years. Expectations, again, what is the market expecting inflation will be over the next 5 years? Well, take a look at this. It was down around 2%. Now it's starting to spike up. So now you're basically at 2.5% going forward over the next 5 years for inflation. My guess is this will ultimately top out around 3%, like I've been saying for a long time. And again, we'll be looking at that over time. I'll continue to follow this chart, but we see that expectations on inflation are now starting to pop, which again, in my thesis about how this economy has major trouble in its future, it's that if inflation is 3% and we go into a recession, the Fed's not going to be able to print us out of it, or they're going to be unwilling until the recession gets so bad that they say, you know what, we can live with 3% inflation. We have to print money because things are so bad out there. Unemployment is 6%, 7%, 8%, whatever it is. So these are things that I want us to be very, very aware of here, folks. Okay, a couple other things. I got to just point this out, guys. So, you know what? In fact, let's just jump over to, bear with me here. So if we look at Apple's chart, now Apple's been one that I've been telling you guys about quite a bit. And we know Apple, again, down slightly today. Actually, it looks like it's up a little bit. So it's getting a little short-term bounce. We still have our technical level. If we zoom out on this chart, technical level is going to be around 175 and change, basically high 175s. That's going to be this pivot high right here. We can see we are very close. So if we get a flush today on Apple, I'm going to start looking at that level for a bounce, just a bounce. All right, Apple to me longer term has to come way, 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 way down. But as a technical bounce, that level is interesting to me. I want to show you this, guys. We always look and say, oh, JP Morgan is a great company. You know, they know what they're doing. We should trust them. I want to show you this, guys. This is a pretty remarkable thing. This is the boosting of target prices just literally on 8/1. So Apple reported on 8/4. All right, so August 4th is when Apple reported. And on 8/1, these were upgrades. JP Morgan, 3 days before Apple reported, boosted their price target with an overweight rating to $235 per share. All right, also TD Cowen, Robert Baird, Piper Sandler, Piper Jaffray, Sanford Bernstein, Wells Fargo, they were all, look, outperform, overweight, market perform, etc., right? All targets were going up. And this is why you have to think for yourself. You know, so many people follow these upgrades and downgrades, yet oftentimes these big banks are upgrading at the highs just before a dump. And I still vividly remember in Apple's history when I was trading 10 years ago on Apple, or maybe it was 7, whatever it was, when Apple was at all-time highs back then, Goldman Sachs upgraded, and that was the top, just like that. Now, again, is it something bigger? I mean, are they trying to unload so they're getting buyers? I don't necessarily know. I'm not going to pretend to know, but I do think it's interesting. All right, so that's just an interesting factor here. So I only have another minute or so, so I just want to do a quick check on the SPY here pre-market. Again, here's your chart of the daily SPY. The reason I'm bringing this up is I've been saying that once this trend line, this upsloping white trend line broke, right here, you had the reversal engulfing candle. Once this broke here, we're going to head down to this level here, which is around 443 on the SPY, all right? So 443 on the SPY. Today, we're basically almost negating that move from yesterday. My guess is we have more downside short term. Then if this line breaks here, that's where the big downside comes in. If this line holds, we should get some sort of bounce, maybe even a retrace back up. But watch this area 443 on the SPY. That's going to be key. All right, guys, holy cow, so much information, I know, but I really want to bring you guys the best stuff that you're not hearing on mainstream media, the insights, the reality of the situation. I'm not sugarcoating anything. Again, my goal here is to give you the honest opinions and the honest data out here so that you guys can go make your own decision. Thank you for tuning in. I'll be back tomorrow, 9 a.m. with more information. You guys have a great rest of your day. This is the Game Plan. Take care.